Hi, my name is Brian Branch. I serve as the President and the CEO of the World Council of Credit Unions. World Council is a global association for credit unions. There are 56,000 credit unions in 101 countries around the world, and credit unions are providing services to about 200 million members around the world. So credit unions came through the financial crisis with very positive results in the terms of membership growth. And people found that trusting their local credit union was a safe place to put their savings. Credit unions continued to provide loans to families that were going through difficult times when someone in the household had lost a job, or credit unions worked very hard to keep people in their homes during a period of difficulties in repaying mortgages. So credit unions, like everyone else, were affected by the impact of the recession when people lost their loans, and credit unions saw some delinquency increase. They came through those times. Credit unions that had investments in some of the large Wall Street banks lost some of their investments, so they were certainly affected that way. But it's been a great period of growth and resurgence for credit unions. So the movement has grown globally, and for example, I was visiting with a group earlier this morning about the U.S. credit union system has grown about 200 million members, new members every year, and the British credit union system, frankly, is one of the fastest growing credit union systems in the world. They grew about 12% in membership in 2012, and stands as a model for other countries. We talk to credit union systems in countries all over the world, and very consistent answers these days when we ask them what their challenges are. Their number one challenge that everyone tells us about is regulatory burden, the costs of complying with increasing regulatory requirements. And secondly, competing with finding their place in payment systems and being able to provide their members with appropriate payment services. And third, membership growth. So in particular, credit unions are readdressing how they provide services and how they are relevant to young adult membership. We very strongly believe in strong prudential regulation. We're about people's savings, and so we want people's savings to be in a safe and secure institution with good management discipline. On the other hand, we also want people to have access to financial services, and a lot of the membership of credit unions are underserved. There are people that have many transactions in their accounts and people who have low balances, and so the costs of complying with a lot of regulatory reporting requirements, for example, makes it difficult, makes it expensive to serve that population. So we spend a lot of time discussing with regulators the costs of increased regulation and how to mitigate that to enable credit unions to continue serving people who are underserved. We feel very strongly that they are better served by financial institutions rather than forcing them outside financial institutions and going to payroll lenders or people outside the supervised financial system. Credit unions exist in most countries around the world, and credit unions provide services to a wide breadth of population. In many countries, credit unions are very involved in providing saving services and financing for small farmers. And so, for example, in countries in Central America, Guatemala, Mexico, credit unions provide training to small farmers so that they're able to meet good agricultural practices and good agricultural food safety standards so that they can sell their produce in the national markets or for export. And whereas it's very difficult for a small farmer to get into these very profitable markets, credit unions are willing to invest in training so that they can increase often their household income by 30% by having proper training and proper certification of the food that they produce. In places like Peru, credit unions do an analysis of the entire agricultural value chain. They map out where the input comes from, who are the input providers, then what the farmer does, how the farmer gets the food to market, how they're sold in the marketplace, and then credit unions provide financing at those various links in the value chain, again, so that the farmers themselves, the actors in that value chain, get a household income. So the combination of that kind of market access with financial services is a double impact. It's a greater impact in terms of household income than simply the finance alone, or simply providing greater access to markets. In Ethiopia, frankly, it's about very basic financial services and training for small farmers. And so we've seen credit unions provide agricultural training, new seeds to farmers in areas of Ethiopia that chronically have been characterized as, by droughts and hunger or food insecurity. Credit unions have been able to provide financing to small farmers, help them improve their production, and so they have a greater income at the end of the season. They invest part, or they save part of that income in the credit union, and the credit union then uses those savings to finance the next crop for the same farmers. And so in areas where chronically we would have seen hunger as a result of droughts, now we see farmers with increased incomes because of the intervention of the credit unions. So the Basel III agreement has affected the operations of anyone who takes savings, and that includes credit unions. Now, and the Basel III agreement establishes a stricter regimen in terms of what counts as capital. So the basic capital of any credit union are the retained earnings, and that's clearly a Tier 1 capital instrument on the Basel III agreement. In some countries, such as Australia, where credit unions had developed supplemental mutual capital instruments, they found that those instruments are no longer considered by the regulator to fit under the Basel III terms, and so they've had to rethink how they increase their capital. The common constraint for any credit union's growth is capital, and with financial margins very slim, and the pressure to keep fees down to provide a fair service to consumers, it's more challenging for a credit union to meet the capital requirements as they grow from their retained earnings compared to another type of financial institution such as a commercial bank, which can call capital from private investors. So it's always a challenge for credit unions in terms of meeting their safety and soundness requirements.